Not all savings accounts are created equal, but most people don't realize how much money they're leaving on the table by sticking with the wrong one. Some accounts barely keep up with inflation, while others lock away your cash with terrible restrictions. So how do you find the best one? In this video, I'm going to break down exactly how to compare savings accounts like a pro, covering the different types of accounts, the traps banks use to keep your money growing slowly, and how to make sure your savings are actually working for you. Let's go. But just before delving in, I want to tell you something. 88% of people who watch my videos are not subscribers. To reach more people and to help them in their quest to become better with their money, can I ask you, if you're not already a subscriber, to hit the subscribe button? It would really help me and the channel out. Thanks for doing that. Now back to the video. Choosing the right savings account matters. Many people just open a savings account at their main bank without even thinking about it. But here's why that can be a mistake. Some accounts pay far below the best available interest rates. Some have sneaky withdrawal limits that stop you from accessing your own money. And some banks offer high teaser rates for a year or less, pulling them in and then trapping them into low returns after that teaser rate ends. And it's important to know, picking the right savings account isn't just about getting the right account for today, for now. It's really about making sure your money grows over time without any nasty surprises. And in this, I include things like thinking you were getting a higher rate because you signed up for a teaser rate account and then that rate dropped, but you only found out 2-3 years later that for all that time you've been earning a pittance on your interest. Now, before choosing an actual savings account, you need to know the types of accounts available to see which one fits your needs. Here's a quick breakdown. First, there are easy access savings accounts. Typically with these, you can withdraw money at any time. Usually, but not always, they have lower interest rates but are extremely flexible. These are the kinds of accounts that are best for emergency funds, or what I call my contingency account, or savings that you think you might need access to quickly. Then there are notice savings accounts. These, like the name would suggest, require advance notice, typically 30, 60 or 90 days, although you can get varying numbers there. You need to provide that much days notice before withdrawing your money. In some cases, you can get access to your money even without notice, but you'll lose interest if you do it earlier. For example, if you opened a 90-day notice savings account and you wanted access to your money but weren't quite able to give 90 days notice, maybe you wanted it within a month, not 3 months, then in some cases you could still get access to your money, but you'd lose any interest over the preceding 3 months or even up to a year because you've given less notice than you originally agreed to. Now, typically notice savings accounts have slightly better interest rates than easy access accounts, and they're best for medium-term savings where access isn't urgent. Then there are fixed-term savings accounts. In these, you typically lock your money away for 1 to 5 years, and they typically have higher interest, but penalties for early withdrawals. And of course, these are for long-term savings where you don't believe you'll need flexible, simple, short-term access. There are also regular saver accounts. These typically require monthly deposits. They provide higher interest rates, but usually for 1 year only, and they usually also have an upper limit on how much you can save each month that benefits from those higher interest rates. I used to use some of these regular saver accounts in my early days, but I don't anymore because the upper limit of what you can save each month is lower than what I actually want to save. These are typically best for developing a consistent savings habit with better short-term returns. There are also cash ISAs, or cash individual savings accounts. These are different to stock and shares ISAs, which are for investments. Cash ISAs are, like the name suggests, for cash. These provide tax-free savings. You keep all the interest and they aren't affected by your personal savings allowance that you get in the UK. Now, sometimes you might hear people say that these types of accounts are best for people with larger pots of money, larger savings, but I wouldn't be so sure. Those ISAs can build up over time. You get an annual allowance, which means you get an allowance every single year, which you can add to. You don't have to max it out every year. And so you can see over time, maybe 10, 15, even more years, you could have a sizable savings amount yourself, even if today you think the amount you can save is small. Knowing these account types helps you match your savings to your goals rather than just chasing the highest interest rates. And then there are premium bonds. I don't particularly class these as a savings account type, but I know some people do, so I'm going to mention it here for completeness. When you buy premium bonds through National Savings and Investments, or NS&I, instead of earning interest, your money, your premium bonds, enter a monthly prize draw. Through that monthly prize draw, you could win anything from £25 to £1 million, but there's no guarantee of winning. For me, it gives you a bit of a thrill, but that's it. It's for people who like the idea of saving, but with a lottery-style element mixed in, and without risking their capital. Though as we've discussed in other videos, you are always always risking your capital that's sitting in cash to inflation. Going into whether it's worth it in a bit more detail. Premium bonds can be fun, but for most people, a high interest savings account of the other types that I've mentioned earlier will grow money faster over time. The current premium bonds prize rate is about 4%, but as I said before, this isn't guaranteed. So some people end up earning or winning nothing. Now, if you enjoy the chance of winning tax-free prizes, then it can be a fun place to park your money, but it certainly shouldn't be your main saving strategy. I said at the top of this video that a lot of people stick to bad savings accounts. Ever wonder why and what that psychology of saving actually is? Even when better savings accounts exist, people don't move their money. Why? Well, for me, there are 3 core reasons for this. One is the convenience trap. I'll just sit with my current bank, thanks. Many people never switch banks because they think it's a hassle, and banks know this. They exploit this by offering loyal savers worse rates than new ones. Number 2, the fear of change. What if I mess something up? Some people worry that moving their savings is complicated or risky, but the reality is exactly the opposite. Switching is safe and easy, and the banks handle most of the process for you. This wasn't always the case, but it's super easy in the UK these days. And then there's number 3, procrastination. I'll do it later. Saving money feels less urgent than spending money. After all, that thing you want to buy it now, right? You want to use that thing right now. But saving, well, you've got time for that in the future, right? But the reality is every day spent in a bad account means lost interest, lost income. Isn't it strange that if £20 was missing from our pay packet, i.e. we got less money in our pay packet than we were meant to, then we'd be pretty angry about it. We'd feel upset and we'd do something about it. But money sitting in a savings account that could have earned you £20 more if it was sitting in a better savings account, well, that doesn't feel quite the same, even though the impact is exactly the same. Strange how the mind works, isn't it? And banks take advantage of this. They lower rates for existing customers while offering high rates to new savers because they want their custom. They've already got yours, right? They also complicate savings terms to make people feel unsure about switching. Banks rely on you not paying attention, but now you know better. Here are some practical steps to compare savings accounts properly. To make sure your savings are in the right place, follow these steps. Compare the AER, the annual equivalent rate, not just the headline rates. They are not always the same thing. Check if the interest rate on offer is a short-term bonus or is it a permanent rate. Look for restrictions. Are there withdrawal limits or penalties? Use comparison sites like Money Saving Expert to find the best rates currently. And above all, don't be loyal to bad accounts. Move your money when better rates appear. And I'm not saying open a brand new account for a 0.1 or 0.2% better interest. That might not be worth it. But if it's 1%, 1.5%, 2.5% higher, then moving could earn you more money. And remember, if you're saving for the long term, you've got to consider inflation too. If inflation is at 5% and your savings account is only giving you 2%, your money is actually losing value. If you think you kind of know what inflation is, but could do with watching a video to really get your grips on it, to really understand it, then this is the one I'd recommend watching next. Or if AEI is something you'd like to delve into deeper, then this is the one for you. Either way, I'll see you shortly.